Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Portfolio Manager. So thankful to have you here this week. We got a couple of topics to drill in with you. We're going to talk about Europe, the continent, and the opportunities that we continue to see there. And then Zach's going to give you an update on growth and value, one of the dynamics inside the market that you have to pay attention to because you usually have one dominating over the other. And he'll give us an update on where we stand today and where we may be headed. But I'm first going to drill into Europe. Bigger picture backdrop. For many years, we really had a light international allocation. We began to beef that up early last year. And one of the ways that we did that was focusing on Europe, and we continue to do that today. So nothing continues to go up in a straight line in markets, nor do we expect that. But we do expect the wind to be at Europe's back, and I'll give you the reasons why and run those down. But first, a disclaimer. The structural reasons on why Europe tends to underperform the United States and our companies is twofold. Number one, their companies have a much lower return on invested capital than we do here in the United States. And two, their economies are growing even slower. Even though our growth has been slowing over the last recent decades, theirs have been slowing more. So those two structural things remain in place. But that having been said, there are some catalysts. The first is really the unleashing of fiscal power. Just for some interesting context here. So if you go back and remember your history from high school, the Marshall Plan coming out of World War II for the US's investment plan back into Europe, the total size at that point in time was about 1% of GDP. And when you look at the cumulative spending on infrastructure and green, and notably defense spending collectively, Germany right now is at that 1%. And a lot of other economies around it are around the 0.3 to 0.5% of GDP and working their way up to the one. So really massive investment, especially when you compare where the European continent has been coming out of the great financial crisis, which has been incredibly restrained and fiscally conservative, often to their detriment. So they are reversing that. This is nothing new, but we continue to see that actually develop. So what was the story last year is really hitting the numbers this year. The other catalyst we would look to is bank capital. And this isn't a lever that has necessarily been pulled, but the signs continue to look to that lever actually being pulled because around the globe, coming out of the great financial crisis, our banking regulators here in the US and others abroad required the financial institutions to hold a lot more capital than they did pre-crisis, right? That extra capital is what helps sustain and really quell concerns in financial crises. But as is usual, the pendulum just swung too far. And so the thought by most is that we hold too much capital now. So the pendulum's beginning to swing back. And if it does, there is a lot of firepower in the European banking system. There is here in the US too, but even more so on a percentage basis. They're somewhere around 15%. We can get into the mechanics at a later date, but around 15% of a capital cushion, something closer to 10 is probably okay. But even somewhere in the middle unleashes upwards to 100 billion euros in firepower. So that does a couple of things. Number one, it can add earnings growth to the banks, and it can lead to faster growing economies as that credit gets extended. So that could be a positive catalyst. And in fact, we'll just take a quick look at the chart here. If you look back over the past 15 years or so, you could see the dramatic difference here. The gold line is the NASDAQ, so a high-powered group of United States companies which have done well, almost 19 or 20% over that period. But the purple line are the European financials. You can see they have just lagged badly, even coming out of that crisis when the financials were decimated. They've only come back at a rate of around 7%. But the next chart will show you, even though that's the case over the past 5 years, believe it or not, the European financials have been outperforming the NASDAQ, really starting early last year. So this is one of those areas that we think could continue. If you look at the valuations here, the European financials are trading just around book value. So there's room for valuation for those of you who'd like to look at that. There is room for valuation to move up, and if they can get their earnings growing faster, that's two key catalysts for a key sector of a lot of international indices. So there's other things as well, but for the sake of time, we will pause there, and I will pass it over to Zach to talk about growth versus value.
Yeah, so the growth versus value factor is one of the primary ways that we can break down leadership in the market. The chart on your screen here shows growth versus value. And so when this line is moving up, growth is outperforming. And then consequentially, when the line is moving down, value is outperforming. You can see from the line there, the red line, that we really peaked in December of 2021. And then during the down year of 22, growth names got hit substantially harder than value, so value outperformed there. But since the end of 2022, we've seen quite the tear for growth names, really leading the market. We've talked about this in other ways in the past with the Mag 7 and some of these high tech names really being what's pulling the market forward. We've seen a couple hiccups here and there, as you see on the chart, with those pullbacks where value starts to outperform. But by and large, it's been a strong uptrend over the past couple of years, and we've adjusted our portfolios to reflect that growth led environment a little bit. But what we're seeing right now, as some of these other sectors start to outperform or start to participate rather alongside the Mag 7 names, as we've seen so far at the beginning of this year, we're starting to see value actually outperform a little bit and take back over growth. Now, what we're watching for is whether or not this trend materializes, meaning it gets back to those December 2021 levels. If it can get through there and value continues to outperform, we may be looking at a scenario where value outperformance is starting to happen again. We may begin to shift some of the portfolios back to the value factor and away from the growth factor. But what we really want to see is for a trend to materialize. I mentioned over the past couple of years, you can see on the chart, we've had some instances where value starts to outperform just to see growth take back over again. So we want to make sure that the trend is confirmed somewhat before we start to make portfolio decisions and start to transition away from growth factor. But it is something interesting to note that at the start of this year, value is starting to outperform a little bit. We just haven't seen that in a while.
All right. Thank you, Zach. Well said. I sure do appreciate it. Appreciate all of you. Those of you who went south for the winter or just lived there permanently, God bless you. It's been a great time to be there. Kind of really choppy weather here in Indiana. So for those of you who are here, stay warm, stay safe on the roads. If we can be of service, please give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks, and have a great weekend.